Thank you, Chairman Himes and Ranking Member Barr for holding this important discussion. And I want to thank our witnesses for joining us today. When I first saw that the Federal Reserve was establishing a facility to help municipal bonds, I was relieved because I know firsthand how challenging the municipal bond market can be. I served in the Chicago City Council, in the Illinois Senate, and the Cook County Board. Unfortunately, our bond ratings make national news. But what that means for us who live in working class communities like mine is that schools, clinics, and libraries closed. It means that my neighbors worry about pay cuts and layoffs every budget season. And you don't need an economist to see that makes our economy worse. So I had hoped that the Fed's municipal liquidity facility would offer some relief, but I represent one of the very few communities that actually use the MLF, and there's a reason many jurisdictions didn't sign up for the program. My state, Illinois, had to attest that we couldn't get financing in the private market before getting help from the MLF. And once we got help, the rates were barely better than the private bond market. So I'd like to direct my first question to Mr. Wooden. When the Fed helped out the corporate bond market last year, did they have to deal with similar terms, the same level of stigma?
With respect to, I did not follow the corporate bond market as I did with the municipal markets. But from my general knowledge, I think the answer is, of course not. There is always a different standard with respect to the corporate markets than the municipal markets.
Okay. And do you think that the municipal lending facility was designed fairly, or did it stigmatize municipal borrowers?
So I will give you in the midst of the height of the pandemic response, which is, I thought it was unfair to state and local governments at the time, the penalty, the off-market rates, and the burdens associated with accessing it, and certainly the fact that it was designed so that not one municipality in the state of Connecticut was eligible for it. With that said, given how our finances turned out in the state of Connecticut and our ability to access the traditional markets and how the facility stabilized the markets more broadly, there was certainly a benefit to the state of Connecticut and to most states in the country as a result on that metric, but not in our ability to actually help municipalities in the midst of the pandemic.
Thank you. Ms. Sam, we're now going through a major crisis, but of course that doesn't seem to be anything new. Every few years, municipal budgets get squeezed because of problems in Washington or Wall Street. After the last financial crisis, municipal defaults and bond rating cuts hurt cities across the country and cut our recovery short. The MLF was a good idea, but it was too little and too limited. How can we proactively address municipal bond issues in the future so that my neighbors don't worry about budget cuts and layoffs because of problems they didn't create?
Right. I think one step forward would be to create more certainty. So to take this time to really structure those programs, make sure municipalities know how to access them, to the point, make sure more municipalities can access them if they need to. I think we've heard a number of times this question of whether emergency lending facilities are permanent or not. That power is in the Federal Reserve Act. Now it has to be authorized by Treasury, but emergency lending facilities will be used in future crises. So, and I very much hope they will be used for state and local governments. And that means that we should do everything we can to make sure they work for state and local governments. And I agree, there's a long way to go here.
Thank you very much, Mr. Chair. I yield back.